Hi, Joseph. Thank you for taking the time to speak with us today on Shariah Global REIT. What is your view on COVID-19 and what has really happened to the global REIT market?
Thank you, Jamie. As countries around the world continue to take measures to contain the spread of the COVID-19 virus, they've implemented policies that have resulted in shutting down significant parts of their respective economies. Restrictions to global travel, and in some cases, a shelter-in-place or total lockdown of citizens has resulted in a significant decline in economic activity across the world. This uncertainty regarding how long this may last and what the ultimate impact to the global economy may be has spurred volatility as financial markets attempt to price in this event. This has led to dramatic actions from major central banks, including cutting interest rates as well as adding quantitative easing measures and other programs to ensure that there is sufficient liquidity in the markets and that global debt markets remain functioning. Governments around the world have also introduced or are expected to implement fiscal measures to assist their respective citizens and economies. The global REIT market significantly outperformed early in the current downturn as interest rates declined and investors took a more defensive posture. As such, the global REIT sector, with its durable cash flows and attractive distribution yields, were an early beneficiary. However, as signs of stress appeared in global debt markets and concerns regarding liquidity mounted, panic selling ensued across all markets and sectors. This caused the global REIT sector's performance to become more volatile and ultimately underperform overall global equity markets. This was similar to what occurred during the global financial crisis in 2008 and 2009, where all markets and asset classes were highly correlated during the widespread downturn. Recently, as measures taken by major central banks such as the U.S. Fed, ECB, and the Bank of Japan have helped ease concerns and improve liquidity in the credit markets, we have seen a return of outperformance by the global REIT sector.
What implications does this have for REIT investors?
The impact on REIT investors will be dependent on how long measures remain in place to restrict people within respective countries to limit and contain the spread of COVID-19. As of now, with many economies severely limited, activity within the real estate markets has also significantly slowed. Due to the uncertainty, companies will be less likely to enter into new lease agreements or take on additional space. Many tenants, especially in the retail and residential spaces, will likely request rent relief or modifications. Current expectations are that this will likely result in a couple of quarters of reduced rental income. However, once the COVID-19 virus is contained or resolved, we expect that real estate activity will return to normalcy, with the first few quarters showing above average growth as pent-up demand is likely. With that said, certain subsectors within the asset class will have more resilient earnings, specifically the industrial, office, and specialty subsectors such as towers and data centers, which have long lease terms, so overall cash flow and earnings should not be significantly impacted over the long term. Additionally, the tower and data center REITs should benefit as demand for mobile data usage will significantly increase during this work-from-home environment. Therefore, we believe that the COVID-19 crisis will not have a significant long-term impact on earnings or valuation.
What are the risks for the global REIT sector in view of the current market situation?
The key risk during the current environment for the global REIT sector would be if the credit and debt markets were to not function properly or temporarily shut down. This would significantly hinder REITs' ability to finance or refinance their respective debt, resulting in significant disruption to their operations. The inability for REIT and private real estate companies to access debt markets or the increased cost to do so can impact the underlying value of commercial real estate. In addition, a restricted credit market would also impact the overall economy and thus lead to continued pressure on economic growth. The next biggest risk to the sector would be the inability of afflicted regions to contain the virus, resulting in more extreme measures that would likely prolong or significantly impact economic conditions, further exacerbating the current issues that the global economy is facing, which could weigh on real estate fundamentals and result in lower earnings and potential dividend reductions.
Can investors expect this strategy to continue paying regular income in the current challenging environment?
Based on current conditions and expectations, we do not at this time believe that dividend distributions will be significantly impacted. Within the Shariah Global REIT universe, the REITs have stronger balance sheets when compared to the overall global REIT sector. In times like these, having a strong balance sheet is critical, as lenders are more apt to lend to those companies that are not highly levered. At the current time, we do expect REITs to experience earnings pressure in the short term, likely 1 to 3 quarters. However, we believe they will continue to produce a level of earnings that will allow them to maintain their income distributions. Once the virus is contained and a return to normalcy occurs, we would expect that the REIT sector will resume the growth that was seen prior to this event, which would lead to an increase in earnings and cash flow, as well as dividends.
Some investors are concerned about the possibility of going into a recession, which may impact REITs as it is highly geared. Should they worry about investing in REITs?
Current expectations are that many economies will likely enter a recession as the COVID-19 virus negatively impacts economic growth. With that said, the length of the recession is projected to be relatively short in duration, with expectations for a sharp rebound in the second half of 2020 and into 2021. Additionally, while any REIT that is highly geared in an environment where growth is decelerating rapidly would be a concern, the rules that are applied to the Shariah REIT universe exclude REITs that have high gearing levels. REITs within the Shariah REIT universe must have debt levels below 33% of the respective asset values. We believe this enables us to invest in high-quality companies with strong balance sheets that can weather these turbulent times.
Why should investors invest in the Shariah Global REIT universe?
We believe that investors in the Shariah Global REIT universe gain exposure to an asset class that over the long term provides income and growth opportunities. In this low interest rate environment, which we expect will continue far after this crisis is over, Shariah Global REITs provide an attractive alternative for investors looking for yield and diversification through REITs that have high-quality asset portfolios with strong balance sheets. Further, our strategy is well diversified with a collection of REITs that have high-quality asset portfolios with strong balance sheets. We believe that investors who allocate a portion of their respective portfolios to the Shariah Global REIT universe enhance their overall risk profile, given Shariah Global REIT's long-term performance over a full market cycle and low correlation compared to other asset classes.
Thank you, Joe, for your updates today.
Thank you, and thank you for your interest and your support.